Welcome back, everyone. Today, we explore a thrilling showdown between two tech behemoths, Amazon, AMZN, and Alphabet, GOOG. These industry innovators not only dominate the market, but also present compelling stock investment opportunities for 2025. Joining me in this analysis, we'll delve deep into their financial metrics, revenue growth, profit margins, and competitive advantages to discern which stock stands out as the premier choice for investors. First, let's examine revenue growth, a crucial factor in assessing a company's performance. In the past decade, both Amazon and Alphabet have exhibited impressive revenue expansion. Amazon reported a staggering total revenue of $638 billion, while Alphabet followed closely with $350 billion. However, looking ahead, Amazon anticipates about a 9% growth in the upcoming quarter, whereas Alphabet is projected to experience double-digit revenue growth. This signals a stronger momentum for Alphabet in the short term, despite Amazon's overall larger revenue base, which is bolstered through diverse streams such as e-commerce and cloud computing via AWS, contributing to its stability. Next, we turn our focus to profitability metrics. Amazon's operating profit margins, while substantial, are often thinner than Alphabet's, thanks primarily to the low-margin nature of retail versus advertising. Alphabet, dominant in digital ads, enjoys higher profit margins, creating a financial solidity that investors often seek. Furthermore, Alphabet's cloud division is flourishing, growing at an impressive 30% annually, indicating a robust future alongside the firm's established advertising prowess. Turning to cash flow, the ability of both companies to generate strong cash flow from operations adds another layer to our analysis, with Amazon's diverse ventures setting it apart in terms of operational resilience. Finally, considering risk factors and future growth prospects illustrates the broader investment landscape. Amazon's expansive infrastructure fosters long-term growth stability, yet Alphabet's focused market strategy positions it as a formidable competitor. In conclusion, while Alphabet holds a slight edge in short-term prospects, Amazon's extensive market presence and diversified revenue streams ultimately frame it as a strong candidate for long-term investments. Thus, it appears both companies harbor unique advantages, but depending on your investment outlook, either could potentially thrive in your portfolio for 2025. Don't forget to like and subscribe for more in-depth analyses like this one. In the corporate landscape, understanding operating profit margins is crucial for evaluating a company's financial health. When comparing Alphabet and Amazon, the stark contrast in their operating margins shines a light on their respective market strategies. Alphabet enjoys a formidable operating margin of 32%, significantly outpacing Amazon's 11%. This disparity raises questions about the underlying factors contributing to Amazon's lower margins, primarily its highly competitive e-commerce sector, characterized by razor-thin profitability. Amazon's commitment to efficiency is noteworthy as it endeavors to enhance its logistics network while trimming fulfillment costs, gradually boosting margins over time. Despite the pressures, Amazon's ongoing improvements in operational practices signal a potential upswing in profitability. In contrast, Alphabet's margins are not only robust, but are also on an ascent, reflecting its dominance in higher-margin businesses. The contrast in their profitability trends illustrates the divergent paths both companies are taking in the technology-driven economy. The competitive advantage each company possesses adds depth to this analysis. Amazon's comprehensive logistic framework and leadership in cloud computing provide a significant protective moat against market entrants. Conversely, Alphabet's core business and search faces mounting competition from AI-driven alternatives that threaten its market share. Amazon's e-commerce strength and cloud dominance serve as pillars of stability, enabling it to fortify its position in an evolving marketplace. When examining cash flow dynamics, Amazon's operational cash flow has nearly doubled over the past decade. This surge is fueled by substantial investments in logistics and cloud-related infrastructure. In contrast, Alphabet has experienced a slight decline in its cash flow, revealing a less favorable trend. While both companies show resilience, Amazon's trajectory provides it with enhanced financial flexibility, allowing strategic maneuverability in the competitive tech landscape. Lastly, assessing the return on invested capital, ROIC, versus the weighted average cost of capital, WACC, reveals further insights into operational efficiency. Amazon records a ROIC of 20% against a WACC of 11%, showcasing a commendable return on its investments. Alphabet outshines with a ROIC of 30% and a WACC of 10%, achieving an impressive ratio that highlights its superior capital efficiency. This financial acumen positions Alphabet as the clear leader in capital returns, providing a decisive edge in the marketplace. In the evolving landscape of technology investments, discerning the better choice between Amazon and Alphabet is crucial for savvy investors. Both companies boast impressive growth trajectories, yet their financial metrics speak volumes about their current valuations in the market. Amazon currently holds a forward price-to-earnings (PE) ratio of 30 times earnings, indicating a more expensive position, while Alphabet presents a more appealing PE ratio of 18 times earnings, suggesting greater affordability in its valuation spectrum. This foundational comparison sets the stage for an intriguing analysis on which stock offers more attractive prospects. Delving deeper into discounted cash flow (DCF) intrinsic value estimates reveals a clear disparity. Alphabet's estimated intrinsic value stands at $238 per share, despite its trading price of $184, marking it as undervalued and ripe for investment. Conversely, Amazon's intrinsic value of $286 per share, trading at $226, also points to being undervalued, yet Alphabet is undeniably the standout option in terms of relative financial positioning. Investors are inclined to favor a stock that not only showcases lower market pricing, but also demonstrates solid growth potential, a focal point where Alphabet shines brighter than Amazon. Turning our gaze towards risk factors, both companies face distinct challenges that could impact future performance. Amazon grapples with regulatory scrutiny amid antitrust concerns, along with a low-margin business model reliant on operational efficiency. On the other hand, Alphabet is threatened by increased competition in artificial intelligence that could undermine Google's historic grasp on search engine dominance. With Alphabet confronting technology-driven disruptions, investors must weigh these unique risks alongside each company's growth commitments. Furthermore, with neither Amazon nor Alphabet distributing dividends, their strategies lean heavily towards reinvestment. Alphabet's stock buybacks present an enticing avenue for shareholder value improvement, whereas Amazon focuses its reinvestment on cloud service and logistics expansion, shaping the future of its growth strategy. In conclusion, while both stocks emerge as formidable long-term investments, Alphabet surfaces as the superior option at present. With metrics illustrating higher returns on invested capital and gross margins alongside a lower valuation, it presents a robust case for investors. As they consider appointments to their portfolios, discussions around the merits of each company will undoubtedly persist. So, where do you stand in this investment debate? Are you leaning towards the growth potential of Amazon, or do you find solace in the valuation comfort of Alphabet?